Welcome everyone to Vested Interest. This is Shane back for a stock pick of the day video. It is Wednesday, June 4th. We're going to take a look at one out of the utility sector, Avista Corporation. Before we get too far in the video, if you could do me a big favor, it doesn't take but a couple seconds of your time, and it does really help out a YouTube channel like mine with the YouTube algorithm. If you could hit that thumbs up button down below if you find any value in the content, make sure you subscribe to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that subscribe button down below. Hit the notification bell so you're notified whenever I put out any new content. I do this stock pick of the day video series Monday through Thursday when the market's open. We take a look at a company stock that's pulled back on the day, run it through my screener, see if it makes it onto my watch list. Now, if it does make it onto my watch list, that does not necessarily mean I am buying. It means I am interested in doing more of a deep dive into the financials of the company, looking at their balance sheet, their income statements, doing a discounted cash flow analysis, and then possibly adding them in the future. I also do some back checks on companies that are already in my portfolio to see if they still meet the initial screener that I set up, to see if they're okay or if I need to do that deep dive back into the financials of the company. And if you could share the video with anyone that you think might find value in the content, that helps as well. And watch time is another one that the YouTube algorithm looks at. So watch the videos to the end if you can. And anyone who would like to help out the channel financially, there is the thanks button down below. You can buy me a cup of tea there. And again, special thank you to the viewers and subscribers of the channel. The channel continues to grow because of guys and gals like you, so I really do appreciate it. This is the Vested Interest stock screener. This is the criteria we will be running through today. We will not look at price to book because this is not a company out of the financial sector. You can see that specifically for financial companies. So don't blindly use one for a fair value of price to book. Make sure you're looking at companies outside the financial sector price to book. You can use price to book for any company, but make sure you don't blindly use one. Look at their historical average for themselves, and you can compare them to other companies in the same sector. Now, if you want to know more about this company, check them out on their homepage, avistacorp.com. That is avistacorp.com. That is their homepage where I pulled this information from. Better energy for life. We are an energy company involved in the production, transmission, and distribution of energy, as well as other energy-related businesses. Avista Utilities is our operating division, providing electricity to nearly 418,000 customers and natural gas to about 382,000 customers across 30,000 square miles and 4 northwestern states. Alaska Energy and Resources Company, and Avista subsidiary, provides retail electric service in the city and borough of Geneva through its subsidiary Alaska Electric Light and Power Company. Avista's history of innovation is rooted in the renewable energy we've generated since our founding in 1889. So if you go to their homepage, right here, it shows their coverage, but it sounds like from the description they have a little bit of a foothold in Alaska as well, in Geneva. I may be pronouncing that name wrong. But primarily, they are in the states of Washington, Oregon, Idaho, and Montana. And you can see here by the little code down at the bottom, electric is orange, natural gas is the blue, and electric and natural gas is this green color here. So those blue spots, again, that's natural gas. The orange spots over here in Washington, Idaho, doesn't look like there's any in Oregon, but that is electric. And then where they have both electric and natural gas would be this green, kind of, again, between Washington and it looks like a little bit into Montana. But those are primarily the 4 states that they serve. Like I said, sounds like this Alaska Energy and Resource Company, their subsidy up there has a foothold in Geneva up in Alaska as well. Now, the reason we are taking a look at them, down 2.64% on the day, we are talking about Avista Corporation out of the utility sector, ticker AVA. Closed off the day at $37.28. They are within 15% of a 52-week low. They needed to be like $38.35 and a little lower, I think it was. 52-week range as low as $33.45, as high as $43.09. Market cap of $3.003 billion, so a small cap company here. Beta of 0.39, much less volatile than the overall market. Very low volatility there. PE, price earnings ratio, is $15.80 per share. EPS, earnings per share, is $2.36 per share. They have an earnings date coming up in August, between August 5th and August 11th. Forward dividend is $1.96. I believe they're a quarterly payer. This is the first time I'm looking at this company, but I believe they are a quarterly payer. We'll see that here towards the end of the video, with a very nice starting dividend yield of 5.12%. Ex-dividend date, May 13th. Looks like they are going to pay out on June 13th. So kudos to those of you who hold this one. You will be getting a dividend payout next week. But you would have had to buy them on the 12th or before of May to be able to get that dividend. So if you didn't own them before May 12th, then you won't get the next dividend. And even if you buy them now, you won't get the next dividend. You're going to have to wait several months to get the next one. Now, their 1 year target estimate is $42.20, so they do see some upside potential from where it currently sits, but not quite back to its 52-week high, which seems to be a recurring theme lately, that a lot of companies don't project back to their 52-week high, and a lot of companies are being downgraded with the tariffs and everything going on. It seems like that is a pretty standard across the board thing that's going on, not for every company, but for a lot of them. Now, jumping over to the right, I like to look at dividend yield theory to see if the company is potentially undervalued. It is just a quick check. It is not the end-all, be-all. It is not a discounted cash flow analysis or any of the other ways you can kind of judge or guesstimate the estimate of a company's value and then use that to estimate a company's stock value that you should pay. But it does give you a quick check. So to do that, we look at their 5-year dividend yield average of 4.52%. We compare it to the current 5.12%. Over here, 5.12%, same number. Since the current is higher than their 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now, typically, I like under 75% for the majority of stock companies, except out of like BDCs, business development companies, REITs, some closed-end funds out there. I should add utilities to that, because typically they are like this company in the 80, 90, even 100% range. Sometimes they're issuing more stock to cover that. But this one is not terrible. You know, I've seen some companies, very few, down in the 60% range. But again, most companies are very elevated, 80, 90+%. They are regulated utilities, so typically they pay out a pretty high payout ratio. It's not uncommon, but they are above the 75% that I typically look for, so 81.14%. Now, dropping down to free cash flow, I want growing free cash flow over time. Typically, if a company has growing free cash flow, they can do some things with that extra free cash flow. They can pay down debt, they can make acquisitions, reinvest back into the company, buy back shares, which it looks like this company is doing, pay a dividend, hold some cash on the balance sheet, or raise that dividend over time, which we want a company to do as dividend growth investors, or at least I do. But looking at free cash flow, again, I want growing free cash flow. So December 2022, negative $328 million, not uncommon for a utility company to be negative free cash flow. They reinvest back into maintenance of their lines, reinvest back into new projects. So they are using a lot. They're very capital intensive. They're using a lot of money to reinvest and keep things up to date. If there's a storm, for example, and they have lines that they need to repair, they've got those costs, putting new lines out there. So there is a lot of cost to utility companies. So it's not uncommon to see negative free cash flow. December 2023, negative $52 million. Now, this is where it gets positive. December 2024, $1 million in positive free cash flow, and the trailing 12 months at $11 million. Now, this does account for some of 2024 numbers, so we'll have to really see how the rest of 2025 shakes out. But really, that is growing free cash flow, even though 2 of the 3, going into 5-year, 3 going into the 4th year are negative. That does show some positive free cash flow growth, again, even though these first 2 years are negative. Repayment of debt. Now, they are not repurchasing shares, but they are repaying debt, and I'm not going to really go into that, because you really need to look at the repayment of debt compared to the issuance of debt for companies like this, or any company in general. Because just because they're paying down debt, like for example, if they paid down $253 million in 2022, but they issued $300 million, well, they didn't really pay down more than they took on. So you want to look at repayment of debt versus payment of debt issued. All right, jumping over to stockanalysis.com. This is another source I go to for information, just like Yahoo Finance on the previous page. I am not affiliated with either source. I just recommend, and I use more than one source, 2 if not 3 sources, to make sure the information I am looking at is accurate and up to date. I recommend you do the same. Now, they do have only 2 analysts that have taken a look at this. They call it a consensus sell, actually, with a price target of $37. It currently sits a little, well, it actually sits a little higher than that. $37.28 would be higher than $37.28. So I don't know why it says negative 0.75% increase. I guess it would have, it would have to drop. Yeah, that's right. It would have to drop by 28 cents or 83 cents in the after hours to get down to the low of 37. That makes sense. Average estimate of $38, that would represent a 1.93% increase from where it currently sits. And if it happened to hit their high of $39, that would represent a 4.61% increase. That's a little bit lower, right? They had them at, what, $42 on Yahoo Finance on the previous page. That's a little bit lower than what they project them to get back to there. So not a whole lot of upside, at least according to these two analysts that have taken a look at this. Now, I also like to look at return on capital employed. I like 10% or better here. Again, utility companies are notoriously terrible for their metrics. Return on capital employed at 4.57% does not meet the 10% I'm looking for there. EPS growth forecasted over the next 5 years, I like 5% or better here. Now, this does meet that one at 6.63% with revenue growth forecasted at 2.33%. Looking at their dividend history here, again, quarterly payout ratio in the 80s, 82.71, so not below the 75% I like for there. They do have a decent dividend growth, 3.21%, which is above the typical inflation we see from year to year, around 2%, but not that much above it. Growth of 10 years, buyback yield is negative at 2.74%. That means they are issuing more shares than they are pulling out of the market. Shareholder yield is positive at 2.45%, which we want to see. Now, they do pay out like most companies do on this same schedule, March, June, September, and December timeline. Going back here to November 2022, they were paying 44 cents per share per quarter. February 2023, they jumped that up to 46 cents. February 2024, they jumped that up to 47 cents and some fractions of a penny. Most recently, February 2025, up to 49 cents. So it looks like they like that around 2% or 2 pennies raise each time, 1.5 pennies, 2 pennies right in there. And I would anticipate their next raise would be February 2026 if they maintain this dividend growth. All right, let's check out the screener here. Understand the business again. They are a utility company primarily in natural gas and electricity. Growing free cash flow, yes, check there. One of the rare times I actually was able to check that for a utility company. Growing dividend, yes, slow growth, a little over 3%, but growing nonetheless. When with such a high payout ratio over 5%, you could do worse than 3% growth on a 5% starting dividend. Dividend payout ratio is above 75%, so no check there. Dividend yield theory says they're potentially undervalued, so check there. It is within 15% of a 52-week low, so check there. Return on capital employed is not over 10%, and earnings per share growth was over 5%, so check there. So we're looking at 3, 4, 5, 6 out of 8. Looks like an interesting company. You'd really want to be looking at how much growth that area of the world might be experiencing and compare them to companies in a similar vein. NextEra Energy might be one that you'd compare them to. That is in my portfolio down in Florida. They provide a bunch of electricity down there. And there's other utility companies similar around the country you can compare this one to see how they shake out. But it does make it onto my watch list. I'm a little hesitant because, again, I'm not really looking for a new position, but this one technically would make it onto my watch list. Let me know what you think of it in the comment section down below. That is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to cover in the Stock Pick of the Day video series, drop it in the comment section. I'll try to work it into the rotation on the day it pulls back. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you are not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select the criteria or seek the advice and counsel of a certified financial advisor. To those of you who made it to the end, thank you for watching to the end. Don't forget to hit that subscribe button on the way out if you have not already done so. Share with anyone you think that might find value in the content. Drop a comment. Let me know what you think of the video. And like the videos if you could as well. Thank you again for tuning in to the end.